Good afternoon. Welcome to Global Hotspots. My name is Kate Preen, and I'm a program manager at the Wisconsin Alumni Association. It is my pleasure to work with the UW-Madison Division of Continuing Studies and Plato to bring Global Hotspots to you here today. Our talk today is America's Macroeconomic Policies and the Global Economy by Menzie Chinn, who is a UW-Madison professor of Public Affairs and Economics. His research is focused on international finance and macroeconomics. He is currently a research fellow in the National Bureau of Economic Research and has been a visiting scholar at the International Monetary Fund, the Congressional Budget Office, the Federal Reserve Board, and the European Central Bank. Ladies and gentlemen, please join me in welcoming Menzie Chinn.
Well, thank you, Kate, for that gracious introduction, and thank you all for braving the cold today to come to this hot spot. I was thinking about a little bit about how I would introduce this. I sort of went through all the slides last night, and then just a few minutes ago I was saying, well, why should you be here? And to try to convince you that it's actually a good time to talk about these topics, let me just say that I'm teaching a class in topics in macroeconomics right now to undergraduates. And I keep on telling them at the beginning of the semester and all the way through the semester, 6 years ago, if I had taught the same class, I would have taught a much, much different class. And what that means is that a lot of the established truths I think we knew in let's say, consensus or mainstream macroeconomics, a lot of those accepted wisdoms have sort of gone by the wayside. And so I think it's useful to sort of reassess in the context of what we have done in terms of revising how we think the world works. So that's what I hope to do in part today, is to get away from just looking at the numbers around the world and in the US and sort of put them in a slightly different context than we would have used, let's say a decade ago. The second is that I was thinking about the irony of the title that I've got here, America's Macroeconomic Policies in the Global Economy, because if you think about it, it sort of implies that the causality is running from the US to the rest of the world. And that might seem a little strange because, for so long we've been hearing about the rise of China, about the development of a united Europe, and the BRICS, Brazil, Russia, India, China as a developing force. That's not to deny that those events are really important, but it's still true that what happens in the US, what decisions we make in the US, have a great import for the global economy. And that's going to be true for at least a little bit more longer time, maybe longer than we anticipate. And so I'm going to try to convince you that that's the case in some of the discussion I have for you today. All right, so without further ado, let me tell you what I'm going to be talking about today. A little bit to place into context where we've been over the past 5 to 6 years. Then talking about some of the characteristics of the recovery in the US economy and how policies here have responded, okay, macroeconomic policies in particular. Then discuss some of the international spillovers that are coming about because of how we've responded to this slow recovery, and actually the ending, or the glimmerings of an ending to some of these policies that we've implemented, and then talk a little bit about downside risks. So I could have crammed many, many, many more slides and points in here, but I figured that what I'll do is try to spark your questions for the ending by going through some of the main issues that I can see, and hopefully we'll cover even more than these particular topics here. Okay, so where have we been? And so here's the first picture. Hopefully you can see these graphs. What is this? This is the growth rate of world GDP adjusting for inflation, and so it's supposed to be real GDP, so the total amount of real output that's been produced. It's the growth rate, and what you can see is that in 2001 we had a slowdown, but then throughout most of the 2000s we had this acceleration in growth in world output. Okay, and then we had this big drop off, and I can say this is our last recession in the U.S. in 2001. This is the recession that started in 2007 at the end, ran to the middle of 2009, you can see that this recession was substantially deeper, both in the US and in the world, than the previous one. And in fact, you have to go way, way back to see anything that's comparable in the world economy. Then we see this bounce back up to pre-crisis and pre-recession growth rates. And then a little bit of a slowdown here as we go into 2013. These numbers are hopeful or wishful thinking. These are the IMF's forecasts for growth going into 2014, 2015. Okay, now if you just looked at this picture, and you might say we're ambling around with 3% growth. That doesn't seem too bad for the world economy. And it is a recovery. We have had a global recovery. One observation I'll make, it's important to know that growth rates don't tell you everything. And I can also do this, which is a plot of world GDP. It's the level, and I've logged it. And the reason I log it is because then a straight line is a constant growth rate. And what you can see is, this is the same time period, 2000 to 2008. We're sort of plugging along this trend. And then what we had is this slowdown, okay? And it doesn't look like a big slowdown, right? That's because China's in there. That keeps us going. If China weren't there, then holding everything else constant, you'd see some bigger drop. The one thing I'll mention is, in the previous picture where you saw that pickup back in growth, you say, oh, things are okay, at least we're growing. The one thing I'll note is that we are growing, but we haven't gotten back to this trend that we had before 2007. Now, there's nothing magical that says that you have to revert back to a trend. Okay, maybe these were unnaturally good times. There was a confluence of positive things, but it does give you some context. The fact that we've recovered in the global economy doesn't mean that we've recovered back to, in some sense, how fast we were going before. Okay, so that's one observation. Okay, so the world economy is recovering, but we haven't gone back to this trend. It's not clear to me that we'll ever get back to that trend. So it may be that we are pushed down permanently and we're just going to parallel this red line. That's actually kind of an optimistic view. Unclear, okay? Now, there's a lot of variation across the regions. And so I sort of alluded to this. We're back to growth rates, and this is quarter on quarter, but annualized. Here are the key things to take from this. This is sort of zooming in to 2010 to 2015. And this is after the recession, the global recession, and we're into the recovery, more or less. And the one thing that's probably hard for you to see, but just let me observe, there's variation. There's a wide dispersion of what's going on in key economies in the world. So here's the US in blue, and you can see that at the end of 2012, we actually had this slowdown that almost got us into zero, okay, zero growth. And we sort of picked ourselves up. This is slightly, if I had yesterday's numbers, this would be a little bit higher here, but not for good reasons. So the US is sort of, if you hear this, these various adjectives, plodding, stumbling, halting, stuttering, recovery, well, that's kind of in the fact that this thing is zigzagging at a pretty slow rate, okay, in the US. But if you think you're bad off in the US, then actually, if you were in Europe, in the Eurozone, you'd say, boy, those people in the US have it good because this is the Eurozone, and you'll see it's under this zero line, okay? Which means what? Which means that they are just coming out of the second recession in the last 5 years, okay? And so, we have had a plodding and halting recovery, but it's been much more serious in the Euro area for a variety of reasons. I mean, the key one is that they've undertaken a set of contractionary monetary and, contractionary fiscal policies in Europe having to do partly with the fact that some of the countries ran into debt problems, okay? But what's true is, the US is in a middling recovery. The Euro area has gone into a recession and is hopefully coming out. And then Japan is doing this wild seesaw here, partly because there's this earthquake and tsunami in 2011. And then there's just a general slowdown in the middle of 2012, partly associated with the fact that China is slowing down, okay? So Japan, since the middle, towards the later part of 2012, has undertaken a whole set of policies to get themselves out of this funk. Pretty extreme and drastic policies, but it seems to have, for the moment, done the trick. So the forecast is, positive growth. This is a statistical aberration. It has to do with the fact that what the IMF has to assume happening in 2014. Okay? And then the thing that's sort of the wildest is that China continues to grow much faster than any of these other regions. And now it's true that the emerging markets in general are growing faster than the advanced economies. That's a fact. China is particularly important because China is big and it's growing fast and continues to grow fast. And so if you look at how much additional real GDP there is to the world economy in each year, China is now accounting for a bigger chunk than the US. Okay. So the US is a bigger economy, but China is growing so much faster that for each year it's adding a bigger chunk to the total world GDP. That's partly why China is so important. When people sweat about whether Chinese growth is going to decelerate and how it will decelerate, in what form, they're worried because China is deriving some big chunk of the world economy now. Okay, so that's a little whirlwind tour of where we've been and sort of the state of the world economy. Let me focus in on the US now and talk for a second about what is the challenge that we face here as policymakers. And so this is a picture I show always in my first lecture in any class I teach that has to do with macroeconomics. This is US real GDP, so sort of taking out inflation. So it's supposed to be measured in real units in the blue line. This red line here is a Wall Street Journal forecast. It's actually, they survey a bunch of economists. They ask you how much you think the US economy will grow in the next few quarters. And this is the average of the forecast. I've just put this in. So everybody projects that the US economy is going to keep on growing in real terms. What is this gray line? This gray line is an estimate of what the American economy could produce if we were utilizing the factors of production at their normal rates, which is, if people were working 8-hour shifts, if all the people who wanted to work full-time had full-time jobs, if we were running the factories on one shift, for instance, and all the factories were being used, and so forth. So it's sort of the output that we would get if all of our resources were utilized at their sort of normal rates. And what I want to point out is the obvious. This gray bar is when the recession was, and you can see that this line continues to be above this line. And this gap here is about 5% of GDP. So the way to read it is that according to one measure, by the way, this is a guess. Nobody knows exactly how much we can produce at a normal rate, but this is the Congressional Budget Office's guess. They have a bunch of extremely well-trained, nonpartisan economists trying to guess what it is that we could produce if the factors of production were utilized at their normal rates. So we're about 5% below normal utilization years and years, well, 4 years, over 4 years after the end of the recession. Okay? So that's why, you ask the average person on the street, are we still in a recession? A lot of them will say, yeah, it's because they're not really, technically a recession is a generalized decrease in economic activity. But heck, it just feels bad for a lot of people. Well, this is the objective sort of description of the fact that it feels bad for a lot of people. It's because we're not producing as much as we could in some sense. Now, what are these numbers here? These are, it's essentially the summation of the space underneath this gray line. So it's the cumulative loss in output. So this 5.0 trillion says that by the third quarter of 2013, essentially from the beginning of the recession onward, we've foregone about $5 trillion worth of economic output. And if these Wall Street Journal forecasts, the survey proves right, by the end of 2014, we'll have foregone another 0.9 trillion. Okay. So, why is that the case? It's partly the case that, there has not, partly we don't know exactly how to get ourselves all the way back up to here. But partly there's there's a political consensus, or been a political decision that we should not undertake more stimulative measures, particularly on the fiscal side. So it's partly, fate has dealt us this hand where we're 5% under, but it's also partly our decisions that we've made that have decided that we're going to not try to push harder to get up to that gray line. Okay. Now, this is a picture that you might not know it, but demonstrates this point that I've just made. This picture is the ratio of the budget balance, or the budget surplus, to potential GDP. And you'll notice this is the zero line. So everything south of that zero line means that we're running a budget deficit. And you can see that this budget deficit reached a maximum in 2009. Okay. Now, since then, you might not know it, but since then, this number has been retrenched considerably so that we're at something like 5%, okay, as a share of potential GDP. And then this blue line is sort of a measure of what the budget balance would be if I took out automatic stabilizers. What are automatic stabilizers? Those are the things that move with the business cycle, like the fact that the tax system is progressive so that when people's income goes up, the effective tax rate goes up. When people's income goes down, the effective tax rate goes down. Unemployment insurance, for instance, is an automatic stabilizer because you pay out more unemployment insurance benefits when you're in a downturn. And of course, when you pay out more unemployment benefits and you cut tax rates, effective tax rates, that's going to make the deficit worse. So, people think of a deficit as really a bad thing. And, all things held constant, you probably wouldn't want to run a government deficit. But essentially, it's the government sort of offsetting the spending that's not being done by people. When households say, oh, I don't have money to spend, I cut back on consumption, I don't go to the doctor, factories, the companies say we can't build new factories, and we're going to cut back on investment. The deficit is partly a manifestation of the government trying to offset those forces by transferring more resources to people or transferring away less resources from people so they spend more, and also doing some spending on its own. So fixing the roads, for instance, that's part of trying to fill the hole in spending overall that is left open by people and the private sector not doing as much spending as what was before. Well, the fact that this deficit, especially this one here, is zooming up to here means that the government is withdrawing that stimulus that it's pumping into the economy. So building the bridges or fixing the roads that would otherwise employ people who would then in turn have income to spend on consumer goods and so forth, that is being quickly withdrawn, okay? Partly because of sequestration, partly because that was already built into the plan, was to cut spending. So if you say to yourself, okay, why isn't it that we are closer to full employment? Part of the reason is because we've undertaken a set of political decisions in which we are raising taxes, but also, actually a bigger proportion, cutting spending, both spending on goods and services and spending in terms of transfers to individuals, okay? And, we'll see, this is projected. It's going to keep on going this way, partly because things like extended unemployment insurance is going to be cut, is going to end, for instance, very soon, and that's built into here. So you got to understand, this picture where the deficit shrinks, okay, you might say looks good, but you got to understand on the flip side, what's true is it means that the government is cutting back on its stimulus to the economy. And if it cuts back sufficiently fast, it may be a long, long time before the economy, before this line approaches this, okay? So we've got adjustment. This term where we're cutting spending and raising taxes has a term or a buzzword. It's called fiscal drag. So fiscal drag is a term that the macroeconomists use, which is just essentially saying, well, as I cut spending and raise taxes, how many percentage points of growth do I remove? And so this is, I didn't calculate off these numbers myself, but this is from Deutsche Bank, and based upon, they probably mostly pulled the numbers from the IMF. And you can see that for the amount of fiscal drag, for some years, it's a negative fiscal drag, which means, in 2008, 2009, we're punching in a lot of money into the system to try to boost it. Then we've got here, we're actually in a year of maximal fiscal drag. It's exactly the fact that we are raising taxes and we are cutting spending by way of the previously planned spending cuts, the fact that the automatic stabilizers are expiring, and some of them at least, and the fact of the Budget Control Act and the sequestration. If you think about, we heard this term fiscal cliff earlier at the end of last year. Well, that's the fiscal cliff is kicking in. And next year, for those optimists, the amount of fiscal drag is going to reduce. The bottom line is Deutsche Bank says that we would have 400,000 jobs being created as opposed to 186,000 on average throughout this year if we weren't cutting back on government spending and raising taxes as we have. Okay? So you might say, today's number of 203,000, you might say, well, look, we're adding jobs at a pretty rapid clip. Let me just tell you that it's going to take a long time to get back to full employment, let's say 6% unemployment, even at 200,000 jobs per month. We have a big hole to dig ourselves out of. And in point of fact, we don't have as many people employed on private payrolls now as we did in December 2007. Okay? That's just another way of saying we have a very slow and halting recovery in the US. Okay. So what have we done in response? Okay, so what are the policy measures that we did do in terms of the fact that we had this slow recovery? We had the stimulus package in 2009 that was a fiscal package, and now we're undoing that. It's pretty much everything that you heard this $800 billion number thrown around in 2009. There's massive stimulus, well, not so massive if you think we got a $17 trillion economy, but even if you thought 800 billion was a lot, it's gone. It's been spent. That stimulus has been spent out. And we're at essentially withdrawing stimulus now. What about monetary policy? So Ben Bernanke, what did he do? Well, Ben Bernanke did this. He dropped the Fed funds rate, this blue line, from over 5% to essentially zero. Okay. So what's the Fed funds rate? Fed funds rate is the rate that banks borrow and lend to, from each other and to each other. And it's the rate that the Fed can most easily control. Why is it important? Actually, in some sense it's not, because I never get to borrow at the Fed funds rate. You never get to borrow at the Fed funds rate. But lots of interest rates are tied to the Fed funds rate. So if I think about what's a 1-month loan, the 1-month loan is going to be average of the overnight loans that you might want to lend to somebody at. And what's that overnight rate tied to? Well, that's tied to the Fed funds rate. So what the Fed tried to do is the traditional thing. As the economy cooled, it tried to pull down the interest rates that you and I face or that companies face by pulling down the overnight interest rate and hoping that that induced longer-term rates to drop. And in fact, you can look at the red line is the interest rate that the US government borrows for 3 months. It actually follows pretty closely. The green line here is the 10-year Treasury rate. And the point is that the longer-term interest rate, you'll notice it kind of comes down with these interest rates. And if I had extended the sample further back, you would see that they move together, but it's not 1-for-1 by any means. Okay? It's never been 1-for-1, but it's not 1-for-1 here. And in fact, the problem is that I actually think this is a more important interest rate. Right? If you think of a person who's running a company and they're deciding to build a factory, are they going to typically look at the interest rate for borrowing overnight or for 3 months? No. They're going to be looking at borrowing on a long-term basis, maybe 10 years. And so this is the interest rate that's more relevant. It's still not the most relevant because that's, the government borrows at better rates than private companies, but you can bet that the private interest rate is going to sort of follow this one. Okay. Now, what was Ben Bernanke's and FOMC's quandary in 2009? The quandary was that they'd hit zero here, and that was the traditional tool that they'd use. Okay. And so, you could just sit on your hands and say, my job is done, I'll collect my paycheck, and I can just tell people, I've done what I could do with short-term interest rates. Or you could think outside the box and say, well, what I really care about is trying to affect this interest rate, and let's say the interest rate that people who buy houses face, mortgage interest rates. How can I try to affect those interest rates, even though I've hit zero here? I mean, some people talk about making the interest rate negative. It's possible. Sometimes that happens, but it's kind of hard to do. My mind always reels when I try to think about how you would actually do it on a sustained basis. So what did the Fed do? The Fed did this. It's hard to understand, but this is what's called the Fed's balance sheet. It was about $800 billion before. The Fed's balance sheet is essentially the Fed has liabilities. It's got assets. The liabilities of the Fed are, for one thing, the stuff that's in your wallet, dollar bills. And the other thing is something you never see. It's banks' reserves. Those are the two liabilities of the Fed. And traditionally, the Fed's played around with this but kept it pretty constant. And in so doing, sort of controlled the thing that we actually see, which is money supply, which is like cash that you have in your wallet plus your checking account. Okay? And it used to be that there was a relationship that was pretty one-for-one between the two. That's another one of those things I have to change my lecture notes from 5 years ago. That's no longer true. The Fed said, look, I really care about the interest rate that long-term interest rates. The short-term interest rates are at zero, so what can I do? Long-term interest rates, I'll try to affect by doing what? By buying long-term government bonds, and that is this color here, gold, I guess. So you'll notice this is the innovation. Before the beginning of 2009, the Fed never holds long-term Treasury securities. It starts buying them up, and the point is what? You buy up long-term Treasury bonds, you drive up the price of those things, you pull down the interest rate on them. Okay, the two move in inverse fashion. The other thing is this big brown area. What's that? That's the Fed buying up, among other things, mortgage-backed securities. Okay, and why would it ever do that? It does that because if you buy up mortgage-backed securities, you drive up the price, and that means what? That means essentially the interest rate that is charged on those securities is lower. But that translates back. Why were those mortgage-backed securities issued in the first place? They were issued because that made it easier for the banks to issue mortgages at lower interest rates. So the idea was by pulling down the interest rate on mortgage-backed securities, you were indirectly affecting the interest rates that homeowners would face when they bought a new house and had to take out a mortgage. So this is quantitative, actually, to be technically correct, it's credit easing. And that is what made a lot of people worried about hyperinflation or inflation, because those people didn't understand the textbooks had been rewritten. In the old days, there was a one-for-one link between what we call the money base and the money supply. And so you'll notice that this thing is right now about 3 times or more what it was, well, almost 4 times as big as the money base pre-crisis. So if I use the same logic I used before, I would say, wow, we're in big trouble. We're going to have the price level jump 4 times. But what's true is the Fed sort of changed the rules, started paying interest on excess reserves, so the banks didn't lend out all the reserves, and so that in turn meant that the link between the money base, this number, and the money supply was essentially broken. Okay, so that's an unconventional monetary policy that the Fed's undertaken to try to stimulate the economy. The controversy is, I think the wrong thing to worry about is inflation. The right thing to worry about is we don't know how well it works. And the reason why we don't know how well it works is because we haven't done it here before. So like I say, Ben Bernanke could have sat on his hands, or he could have tried something that he had an inkling might work. And this is the point. This is the measure he undertook, along with the rest of the FOMC. Okay, so time is running out. Now you know the context for what we've been doing, what's happened in the world economy, what's happened in the US, what policies we've undertaken. So going forward, what are the effects that we need to worry about in terms of our policies on the rest of the world? So I'll talk about growth effects, talk about uncertainty effects, and then monetary policy effects. So here's a nifty graphic I stole. Remember I talked about the fact that we had fiscal retrenchment or consolidation. The budget deficit is shrinking rapidly. Fiscal drag is rising. What's going on? Government spending is being decreased, both defense and non-defense, and taxes are rising. And if growth slows down here, then you can imagine we import less, and but our imports are somebody else's exports. And so there's a direct transmission process to the rest of the world. And so this is a study by the IMF. They ran through their models, the statistical models, estimates. If I have a 1% decrease in the growth rate in the US, how does that spill over to the rest of the world? And blue is not much. So like Australia, India, not much of an impact. A little bit bigger impact for China and a lot of other countries like Japan, more for Thailand. For the life of me, I don't know why, but that's the case. And so you can see who gets hurt the most are actually the Canadians and the Mexicans. Well, that's just a manifestation of the fact that they're so closely interlinked with the U.S. It might not be known to you, but our biggest trading partner is not China, it's Canada. Who's next? I'm pretty sure it's still Mexico. And so that's why you have these impacts here. Okay, so in some sense, the fact that we have this fiscal cliff being experienced in the U.S., there's some impact on the U.S., of the U.S. on the rest of the world. It's not a good impact, especially you can imagine we sort of push some countries over into an out-and-out slowdown if they were teetering. But I don't think that's the biggest impact. It's not the biggest thing that people worry about. It's uncertainty, financial uncertainty. So, there's a whole literature that's grown up that says policy uncertainty, what are tax rates going to be next year, and so forth, what's going to be government spending next year. That has a negative impact on output. There's also another literature that says that economic uncertainty might depress investment in output. Let me just show you some pictures here. This is a measure of policy uncertainty, and I'll just say that where are these peaks? These peaks are at debt ceiling imbroglios. So here's the debt ceiling debate in the middle of 2011. This led to the sequester, right? Remember, the sequester was a plan that was going to be so stupid that nobody would let it happen. Well, of course, we did. So, it came to here, and then we actually implemented the sequester. We tried a last-minute deal. And then what's this here? There was a debt ceiling debate here, but here's the next debt ceiling debate. And so, yeah, there is policy uncertainty. We actually don't know how much of an effect there is on actual GDP. Some economists claim that you can measure it. The one observation I'll make is, if you thought it was a bad idea to have lots of policy uncertainty, we keep on shooting ourselves in the foot. Okay, we keep on coming up to this brink. And I don't know. We'll see it come again. The next debt ceiling debate will be sometime in March or something like that. Not sure exactly when. We'll see if we once again raised uncertainty. Actually, you don't need to look at this. The other bit of uncertainty, there's another way to measure uncertainty. It's not policy uncertainty, but it's sort of economic uncertainty. Some of you will know this. It's called the VIX index. It's the volatility index for American stocks. And it's some number that you pull out of options prices for stocks. All you need to know is it goes up when there's a lot of economic uncertainty, particularly financial uncertainty. It's a funny index because it pertains to America. It pertains to the American stock index. And here's the strange thing. Whenever there's heightened uncertainty in the US, measured by this index, you'd think money would run away from America. But actually, money runs to America. That is, capital inflows into the emerging markets decrease, and the capital seems to reverse and go back to the US. Okay, there are explanations for that, but the importance of that is whenever we jack up economic uncertainty in the US for whatever reason, could be something that happens in the financial sector, could be government policy, whenever that happens, it actually hits the emerging markets in a bad way. It tends to pull money out of their economies, and if they're not prepared for it, then it puts stress on their exchange rates and their the foreign exchange reserves. So that's one way in which uncertainty in the US has its ramifications that go far beyond our borders and affect in a big way key emerging markets. Okay, the other thing is that you have to be on a watch for coming up in the next year is the reversal of quantitative easing and credit easing. So I showed you that picture about the Fed buying long-term treasuries and mortgage-backed securities. We're now considering pulling that back, okay? And not selling the things that we bought, but actually just stopping our purchases. That's the taper. And the interesting thing is that when Ben Bernanke said, essentially he thought he was just saying the same thing he had been saying before. But apparently the markets thought he was saying something different than he had been saying before. And that the mere mention of the fact that the Fed would be considering tapering as it had been considering tapering all along sent the markets into a tailspin. I happened to be presenting a paper at the Bank for International Settlements exactly in June when the whole thing was happening. This is what the taper is. The taper is we stop, we've been buying and buying and buying these assets, so the balance sheet is increasing. And then the taper is not actually stop buying, but slow down your buying. And then eventually various securities will mature and go off your balance sheet. So eventually, 2020, you're still got a much bigger balance sheet than what you had in 2007. And yet this is exactly what spooked the markets. This the mere mention of this. Or it could be the mere mention that we would raise the Fed funds rate. So this is what the Fed has been saying that it's going to be doing with the Fed funds rate. But people can get worried. And apparently people interpreted Bernanke's statement as a statement also that this thing would go up faster, even though logically they're two distinct and separate operations. So, difficulty in communication. This is what happened in response. Essentially, these are a bunch of emerging market currencies, Korea, Turkey, South Africa, India, Brazil. This is essentially when Bernanke makes this allusion, and then you can see these currencies do what? This is the August 22nd observation. I happened to tabulate this for then. You can see all these currencies took not all of them, but these currencies took a nosedive. And that's a manifestation of their essentially people saying, oh, the taper is coming, interest rates are rising in America, and capital starts flowing back to the US, away from the emerging markets where they've been during this period in which we'd undertaken quantitative easing. Well, that's actually the main, this is, if you think about the irritants for emerging market policymakers, this is one that the Fed does these things and they're in some sense, at the whims of what the Fed does. The other one is they can't understand why we keep on coming up to this debt ceiling and almost, defaulting. That does nobody any benefits in the economic world. And so, these two things are a consistent source of irritation to them. That's just a manifestation of the spillover effects. Okay. So I'm out of time, so I've timed this right. I've covered a lot of material, but I hope I've convinced you of several points. So the US remains the key in the global economy for now. It's, we're still the largest economy, but, by 2020, that may be different. But even after taking into account that we won't be necessarily the biggest at some point, the fact of the matter is the financial markets are, in some sense, centered here. The world relies upon the dollar for financial transactions. U.S. government debt is one of the most widely held assets and thought of as the most safe. So the U.S., for better or for worse, is at the center of the system for now. Keeping that in mind, with the world economy in really a fragile state, then what we do here could certainly tip the world economy into a recession. I mean, I don't think that's likely, but you make a stupid mistake, something sufficiently stupid, and there you are. So actions in the U.S. could easily just derail that recovery. And if I had to think about the two things to worry about the most, it's a rapid fiscal contraction or another debt ceiling crisis. Those are the worries I have from the U.S. You can always think of the worries from overseas. If there's a blow up in the euro area, some stabilization package or a program in Greece or in Spain, finally derails a government and the new government says we're not sticking by this. Or if China has some mishandling of how it implements its sort of transformation of its economy, those are possibilities. But sort of paid to think about American potential missteps, and these are the two that come to mind. Okay, so on that optimistic note, let me close and thank you for your attention.
Thank you, Professor. We have a few minutes for questions, so I'll be coming around with the microphone.
Thank you very much. The data that you presented, the results are as good as the information going into it. How good is the data that we're getting from China? I've heard different stories about that.
So the question is about data from China. I think that the authorities have improved the quality of their data over time, at least at the aggregate level. I mean, if you want to know things like what's the amount of lending that takes place in the banking sector versus the non-banking sector, quote-unquote shadow financial sector, I'd worry a bit more. But what's true is that over the past decade, we've developed, the private sector has developed alternative indicators and that seem to mirror actual GDP. So I think we have a better grip on the sum of the value of output in China. But there are going to be questions about the composition and what it means. So.
It appears to me that the government seeks to influence the economy and consequently the quality of life of its citizenry. And many of the mechanisms that the government has are imprecise and sometimes very indirect and verging on wishful thinking. And one I'd like clarification or insight from you on is the idea or the claim that raising taxes on the wealthy hurts jobs. I can understand if you assume, well, if I take money away from this rich person, they're not going to be investing it, and that investment creates jobs. But if I were thinking about, okay, you're not going to take some money from me, okay, I'm going to seek to increase my net worth with this, that doesn't mean I'm going to be creating jobs. I'm going to be looking for whatever the most effective way of maximizing my profits are, irrespective of jobs and so on. And I'm wondering how tightly linked or how how valid is that argument?
Okay, so that's a question with a lot of parts to it. Let me first say, as economists, we typically think of incentive effects. So once I raise the marginal tax rate on any given activity, there's going to be a decrease in that activity. And there's a relevant question about, what's the job creation aspect of it. The way I would view it is, what's the cost? If you raise the marginal tax rate on, let's say, multi-billionaire or corporation, let's say multi-billionaire, maybe there's a small incentive effect, okay? But I may, if the change in behavior is not much, then the increase in the tax rate times the small, the slightly reduced amount of activity means that my revenue increases a lot. So it would be essentially, what's the elasticity of tax revenues with respect to that tax increase? My guess is it's probably pretty high, but that's an empirical question. That's what employs many, many, many economists, trying to measure what those marginal rates are. The other thing is to understand is that that's a partial equilibrium. I'm holding everything else constant. What's also true is if I have more tax revenue, then the budget deficit, holding everything else, is smaller. Or if I increase spending in the same amount that I increase tax revenue, then that's going to have some impact as well. So really, in the end, there's a whole bunch of things that I'm not just going to say depends. What you would do is you would say, if I were a macroeconometrician, I would sit down, I would say, what's this elasticity? What am I going to do with the funds? If I'm going to pay down the debt or reduce my budget deficit, what's the decrease in the interest rates that results from that? And then what's hence the increase in investment and economic activity that results from that? Or alternatively, if the government's going to spend it, what's it going to spend it on? Is it be more transfers? Is it going to be building more bridges? Is it more tanks? Each of those has a different multiplier impact on economic activity. So to me, let me put on my technocratic hat. It's a question of what are the elasticities involved in each of those steps in the process of thinking about what happens.
And my understanding is that and to and the world economy, if that indeed does happen.
So the question is, other countries want to establish their own greater use of their own currencies in international transactions. It depends upon in what dimension, but I'd say it's a hard thing to do to get your currency to be used. For instance, the most important one I can think of is to be able to borrow in your own currency in large amounts. And the reason is because many countries have run into problems where they defaulted on their debt. So I would say that Argentina will have a long time before it has its currency used as a reserve currency, something that's held in central banks in large amounts. The dollar is now, as best we can guess, something like 70, accounts for 70% of international, 60 to 70% of international foreign exchange reserves. And that's a dominance it's had in most of the post-war era. And there are very few switchovers in time in terms of these uses. So Germany overtook Britain in the 70s. But other than that, there have been very few switches in the rankings. And even the euro is a distant second to the dollar. So I wouldn't expect a switchover soon. Now, if it were to happen, I say never say never. If it were to happen, what would happen is that the U.S. would not be able to borrow as easily. So there's a phrase coined by Charles de Gaulle where he says, essentially he says, to paraphrase, those Americans get away with murder. Okay, and it's not exact translation, but it's the idea that we can do all sorts of things with our fiscal policy, and people keep on buying U.S. government debt. And it was an exorbitant privilege, he said. My former teacher, Barry Eichengreen, has an excellent book on this, that title, if you want to get it. We, in some sense, have done a pretty good job of squandering some of that, justification for having that exorbitant privilege. So it's possible someday you'll have a new key reserve currency. I don't see it real soon. More likely, you'll have other currencies get more importance in international reserve holdings, and that would mean that it'd be easier for them to borrow. So I see the ramifications as being bigger for them than it is for us.
Yes. In roughly the last 100 years or so, we've built an amazing middle class in the United States, based very much on model manufacturing, and wages, the union, et cetera. And it seems over the last 20 years that through automation, shipping jobs abroad, et cetera, we're seeing more and more people that were making a wage that are now at 40 and 50 years of age, that were making $25, $30 an hour, will probably never make more than $50 an hour. What impact does this have in long term the and the consumption that ultimately drives a lot of our health.
Well, that's a super big question. So I'm tempted to sort of defer that and say you should talk to a trade economist or somebody like that. These are difficult questions because we don't actually know the source of the reason why inequality has been rising. I mean, there are various parts of inequality, right? There's a disappearance at the middle. Then there's this rise in extremely high compensation at the very top of the income distribution. It's not clear to me it's all the same phenomenon. And so I don't know why at the very, very top you have this incredible phenomenon of increasing concentration. In the middle, you know, this is a tough question. I think there's still split between is it international trade, competition, or is it just the nature of technological progress? And I think a case can be made for both, and I can't claim to be an expert. If it is international trade, then there's a little bit more hope because you don't have a China dumped into the international trade system every year, right? China, even as we speak, is doing what? It's seeing its wages rise on the coastlines, driving production either inland, where it's more, you know, it's less efficient to get out to the rest of the world, or some of the production is being reshored to the U.S. Okay. That being said, you know, it's not the stuff that's being reshored to the U.S. is not like your grandfather's job at manufacturing with a drill press or something like that. It's like operating an automated machine tool or something like that. So it's it seems like it's a combination. If it's trade, then I can see a little bit more hope. If it's not trade and is primarily technological progress, that's a severe problem. What that bodes for the future, well, you know, that you could imagine that if you got an extreme distribution, consumption probably can't grow as fast as it otherwise would have. You know, the poor can only consume what they get in income, and the rich don't, you know, probably don't have a particularly high marginal propensity to consume. I mean, how many yachts can you buy? I'll defer the rest of the question and say that there are certain things we could do in terms of policy. You know, a minimum wage increase probably would help. Presumably, if you somehow strengthen the ability of unions to negotiate, that would change the balance between management and labor. But there are no guarantees in all of this, and that's as far as I'll go as a macroeconomist.
This may be related to the question about reserve currencies. In many areas where we have potential disputes with China, can China realistically threaten to slow down its buying of our debt? And if so, how big a threat is that?
China's already slowing down its purchases of U.S. treasuries. And it's by virtue of the fact that their current account surplus is smaller. So, you know, go back 2006, 2007, essentially their trade surplus as a share of GDP was approaching 10%. Now it's something like 3%. The economy is much larger, but, you know, they're essentially the excess of what they're selling to us minus what they're buying from us, or where us is the world, except in China, that shrunk considerably. And so their pace of accumulation of reserves is slowing down, and on top of that, you know, they're probably buying from different places. We actually have no idea. We don't know exactly what they hold, but my guess is they've already slowed down their accumulation of dollar assets. So they don't have to threaten, you know. But there would be pluses. So the minus is interest rates, borrowing costs for the U.S. will be higher than otherwise would be if they're purchasing fewer U.S. Treasury bills, bonds. On the other hand, you know, to the extent that we're not importing as much from them, and hopefully then from the rest of the world, then some production that had been overseas would then be, you know, reallocated to the U.S., hopefully with additional employment consequence.
We have one more question.
Sorry.
If the U.S. Reduced its corporate tax rate to 15%, would that be a net benefit to the world economy?
So if they reduced it to 15%, net benefit to the world economy, that's, I honestly have no idea. I mean, I suspect, because it depends so much on a lot of other variables, and it depends in particular in the sense of how it's done. If, for instance, I reduce the effective, the corporate rate to 15%, the statutory rate, and I got rid of loopholes, accelerated depreciation, all the little things that give employment to tax accountants. And say I increase the amount of tax revenue, for instance, then it seems to me, at least for the U.S., it's a plus. The problem, you know, we have a pretty high statutory tax rate for corporations, but it's riddled with these, you know, carve-outs and so forth. And so it's not a particularly efficient way of raising revenue. And so if you could make it a more rational one, then that could be a positive. And you know, my guess is, you know, that's why the Obama administration views that as something that they would like to implement. For some reason, you know, the Republicans are demanding something in response. You know, they want something in order to implement it, but it should actually be something that they would want too. So it's a puzzle. But these things that involve tax code are often very difficult because the winners know they're winners and the losers don't know that they're losing out very much. And so we're sort of frozen. But my view is, at a distance, it would be a plus for the U.S. Particularly if it combined with some sort of agreement on harmonization across borders, so that, you know, firms can't somehow game the system going from place to place to place. That would be the thing. I mean, one of the issues is that over the past 20, 30 years, we've had increasing mobility of capital across borders. And that's one of those things that international macroeconomists love to talk about, you know, try to measure and so forth. But I think it's true. And what that's done is it's sort of eroded tax bases so that countries are trying to cut tax rates. But if you could coordinate these tax rates in a way so that you are all at some sort of level, then there'd be less of the gaming of the system in this race to the bottom in terms of tax rates. And so maybe we would be able to raise more tax revenue that way.
Thank you very much. Please join me in thanking Professor Chinn for being here with us today.
Thank you very much. Happy to answer any more questions. Thank you.